It is good to be with you all today. And I wanted to start off this webinar by saying that when I got the information together for this, I was admittedly blown away by some of these numbers. And I feel like it's very important that we have a good discussion here and really evaluate the challenges that are facing business owners. Now, admittedly, some of the data here is older, some of it's newer, but the story that's being told in these numbers um, is one that should be alarming. And if you are interested in successfully exiting your business and making sure you get premium value, I would encourage you to take these numbers to heart. So, what we're going to do now is we're going to dive in right now, and I'm going to uh, take a look at exit planning by numbers. And we have a lot of statistics here that I'm going to fly through. I would definitely encourage you, if you want to just feel free to replay segments of this webinar just because these numbers, yes, these are the most current numbers that I can get, and they really should jump off the page at you. So what we're going to do is we're going to start out by looking at the $3.7 trillion problem. Now, what this is this is an aggregate value gap across U.S. businesses, according to the Exit Planning Institute in 2024. There's an average $900,000 value gap for small businesses and a $1.3 million for mid-market companies. That's according to the Capitaliz analysis. And this comes from 2.9 businesses owned by individuals over 55, controlling $6.5 trillion in annual revenue. Okay, some really big numbers right off the back. And really, what the point is showing just what the valuation gap is there. Um, and here are why the stakes are so high. 73% of privately held companies plan to transition within the next decade. Now, Raymond James recently did a survey, and they found that number a good bit higher at 88%. But only 20 to 30% of these businesses that go to the market actually sell. And this is a study that was actually done by the EPI back in 2023. So that means up to 80% of attempted exits fail. So now that we've kind of dived into that, let's take a quick look at the survival reality. What does it take to actually make it to the exit? Well, only 34.7% of businesses survive 10 years. 20.4% fail within the first year, and 49.4% fail within 5 years. Um, Construction is a 24-point decline in the first year. So, with agriculture having the highest survival, while mining and oil and gas having the lowest at 24.5%. So really, the numbers here should show you that if you're able to get past that first 10 years, you have a really good chance of survival, especially if you're able to get past the first five. So really, businesses where, if you are an owner and you've held the business for about 20 years, you have a very, very good chance of survival. Now, of let's take a look at the closure versus the sale gap here. And of business closures, only 20.3% are a result of sales. 25% fail because of low sales or cash flow, and 21.9% it's because they retire without finding the buyer. So, in other words, one out of every five businesses that close, they close because the business owner could not find a buyer, so they chose to liquidate. Now, one third of businesses that closed were actually profitable at closure. That is crazy. One out of three businesses that close, they weren't closing because they weren't profitable. They actually were profitable when the owner decided to close them. Now, here's a market transaction reality, and this is from Biz Buy Sell from 2018 to 2022. The median close rate, it's 6.46% for small businesses. Now, for businesses with revenue between 5 to 100 million, which is the area that I like to function in, 250,000 companies will try. Of that, only 20%, 50,000% are market ready, and just 30% will successfully transact. Those numbers are pretty crazy when you think about just the revenue that they're generating. That these numbers, that only transactions will be successful 12% of the time. So here's the key takeaway: most businesses just don't survive long enough to sell, and of those that do, 4 out of 5 don't find buyers, and you can see that in the statistics. So why is it they don't find buyers? Well, here it is, and that's the preparation gap. Now, according to EPI, the planning deficit statistics, 78% lack formal transition teams, despite 68% seeking advice. 94% have absolutely no written plan for what they're going to do after their exit, and 49% have done absolutely no exit planning at all. So here's the reality: when you just look at those numbers, it's not the fact that, you know, they're not asking. I mean, according to this, 2/3 are actually seeking advice, but they have not actually developed a formal plan. So, really, the big thing here is it's a matter of simply doing it, just developing the plan. Now, there's also a psychological delay. 63% say that it's too early to begin succession planning. Well, let's nip that one in the bud. I've heard people say that you should start planning your exit from day one. Honestly, I feel like if you want to really be well ahead of the curve, as soon as you start the business, start thinking about, well, hey, how am I going to exit successfully? 45% say they're too busy. Well, here's the reality: if you're too busy, what's going to happen when you have to exit? Not necessarily by choice, but by necessity. All of a sudden, that being too busy, that's not going to age well. 1/3 don't have long term plans or are unsure. In other words, if you're not, 1 out of every 3 business owners, they haven't thought ahead. They have no idea what's coming next. So now let's take a look at planning by business size. Of businesses which have $500,000 in revenue or less, 74%, or 3 out of 4, did no exit planning. Businesses 500K up to a million, 67% no planning. 1 million to 2 million, 63% no planning. And 2 million to 5 million, 57% no planning. So as you can see, the larger that the business gets, there's more likely to be planning done. But the reality is, even in the case where they're actually the highest amount of planning, only 43% have actually done planning. Now, let's get into where the numbers really get ominous. 80 to 90% of the owner's wealth is tied up in business. In other words, if you're a business owner, 10 to 20% of your wealth is not concentrated in your business. Now, to have somebody with 80 to 90% of your wealth in one thing, that would be viewed as a significant risk. If you're a business owner and you have 80 to 90% of your business coming from one client, I can guarantee you that business is not going to sell. And the reason why is because of the fact that a business is going to take, a buyer is going to take one look at that and go, that is way too much risk concentrated in one place. Now, 70% depend on business income for lifestyle. Obviously there are lifestyle businesses which they're not really going to sell. And I think the reality is most people who have a lifestyle business understand that. They enjoy their work. But, if with 7 out of 10 business owners actually depending on their business income for their lifestyle, again, that's a major risk. Is like, if something happens to that business, Well, there goes your lifestyle. You're going to have to reinvent everything. 78% plan to sell to fund 60% of their retirement. Now, that was from a statistic taken back from CNBC in 2015. But think about that. 8 out of 10 business owners are going to depend on the sale to fund 60% of your retirement. So, a key takeaway here, seeking advice isn't the same thing as taking action. The gap here between knowing and doing is costing millions. So now that we've taken a look at that, let's take a little closer look at the valuation gap, leaving money on the table. Well, as we pointed out earlier, there's a $3.7 trillion aggregate gap across U.S. businesses, with a 900,000 average gap between small businesses, 1.3 million with mid-market. Companies with 10 million revenue or more, it is 2.5 million on average. And that's 2.5 million plus. So if you have a business making $30 million a year, there's a good chance that like the average is 2.5 million. It could be lower, it could be substantially higher. What are the causes of these valuation gaps? Well, here's a list. Inherent operational risks that, a business owner a buyer will look at and go, well, they're too risky. We don't want to take a look. We want to invest. Lack of predictable profit or cash flow foundation. In other words, a business owner is looking and thinking, okay, you have cash flow issues. We don't want to buy that. Or, we look at the profit. It's like there's no rhyme or reason. It's up and down, and there's no steady. It's not steady, and there's no growth trajectory. It's like 1 year it's way up, 1 year it's way down. Inconsistent growth patterns. That kind of dovetails with that. Weak competitive differentiation. In other words, if somebody were to ask, okay, what differentiates you from your competitors? And you stammer around for 5 minutes, well, that's a big reason. Poor financial documentation, or what we would label, maybe needing to clean up the books. And then, of course, customer concentration issues that I've touched on earlier. Now, here's the impact on sales. A well-prepared business is going to avoid 10 to 20% of valuation discounts. And this valuation gap, a lot of the time it comes down to a buyer, such as a private equity firm, looking at the business and going, I see that you're valued at this, but because of what we're going to need to do in these areas, we're going to give you this amount. And it's going to be a substantial discount just because they know they're going to need to invest and they're going to need to get some things fixed up. So proper preparation can, as you can see, it can rather dramatically increase prices just because the seller is going to go, no. We actually have addressed all of these issues. And since we have the business valued at this, you need to pay this or else we're going to find another buyer. So really that valuation gap is one of the big reasons why sales fail to close. Now, there's also a bit of a satisfaction crisis here. 20 to 25 businesses going to market close, but of those, only 12% of owners are satisfied with the results. Just 2 to 3% of business owners who start the exit process are genuinely happy. Think about that. That means for every 100 business owners that start the exit process, only 2 to 3 of them are happy. I know where I would rather be. I'd rather be in the 2 to 3 that are happy as opposed to the 97 or 8 that are not. And I've seen this number at 70%, at 75%, but 75% of people report they're regretting that decision within 1 year. The takeaway here being the gap between what owners think their business is worth and what buyers will pay is going to likely destroy deals, more deals than any other factor. So now that we've looked at that one, let's take a quick look at this transaction timeline and how long it really takes to sell. Well, the time on the market trends, now the average has grown from 6 months to over 10 months. Now, obviously, with investment bankers and business brokers, there's going to be some variation in there. Uh, it might be a little smaller with some, a little longer with others, but nonetheless, uh, the time on the market is growing. And as we head into the baby boomers deciding to exit, and there's an even larger glut of businesses, there's a very good chance that this is going to continue to increase in time. Overall average, about 200 days, 7.3 months. Sale price, if it's under 100,000, you're going to be on the market 199 days. 1 to 5 million, 291 days. And, there's also a bit of an overpricing penalty that's in play. Businesses that are priced 76% above the selling price, they're going to take about 40% longer. So, yeah, you might get what you're asking for, but you're going to wait a lot longer to get it. So, basically it's 285 days versus 203 days at market pricing. So, if you think it's worth more than it really is, get ready for it to be pushing a year before you close. And even then, you may have to cut the price. So, price achievement. Businesses typically achieve 90 to 97% of the asking price. So, in other words, if you're going into, if you're thinking I'm going to sell it for 40 million, don't expect to get 40 million from it. A good bet between 36 million to maybe, say, 39 million, which, still, that's nothing to sneer at. But the reality is, don't go in thinking, okay, you won something from it and you're actually going to get a larger number. It is possible, but the statistics don't back that up. The national median is 92%. And, the historical consistency is back in 92, it was at 84% of business owners getting the price. 80 business owners got 84% of what they were asking. In 2012, it was 87%, and then 2018 is 93%. So historically, things are actually trending in the business owner's favor. Now, the current market headwinds, and this is from Q2 of this year, so there's a possibility that there's a lot of noise with these numbers, just because I know that at this time, this was in the midst of the tariffs and basically the trade war. So there's going to be some variation, and obviously, there's been some significant economic challenges the last 5 years. So, these are going to be playing. The median sale price was down 6% year over year. Median cash flow was down 2.6%, and transactions were down 4%. All these are year over year. And the average time on the market was actually up 12 days due to new SBA rules. So here is the key takeaway from this. If you think you'll list on Friday and close by Christmas, you're in for a rude awakening, especially since, if you think you're going to be able to list it on Black Friday and yeah, somebody's going to buy it. No, you might close by next Christmas if you list this Black Friday. You aren't going to close this Christmas. And again, that's assuming everything goes right. So let's take a look at, some of the other deal killer factors. We've already looked at a big one, which is the valuation gap. 60% of executives attribute deal failures to poor due diligence. This was a study by Bain & Company done back in 2020. 62% of M&A transactions fail to meet financial objectives. This is a Harvard Business Review statistic. Overall M&A failure rates are between 70 to 90%. And then technology acquisitions, 76% fail to meet objectives. And I should mention on the failure rates is those numbers, don't think okay, that's necessarily indicative of all businesses, because the reality is businesses that do sell, sometimes it may actually be the second or third buyer. So there are going to be some failures potentially within the transaction process itself, but even though the transaction might be successful at the end of the day. So here then, based on looking at those rates, are the top deal killers. Financial documentation issues where we have discrepancies between statements and tax returns, overstated cash flow, and lack of supporting documentation. This is why cleaning up the books is so crucial. And that is one of the areas that I look at. In fact, I actually have an assessment that the accounting team is supposed to get. And even though it's called the gap accounting assessment, where I'm trying to determine, even though I'm not necessarily trying to make sure everyone is gap compliant, I'm trying to figure out, okay, what are you actually doing, and do you have consistency? And if you're all over the map, well, it means we likely have some significant documentation issues to clear up. Customer concentration is risk. If you have a single customer providing 10% of your revenue, that's a red flag. Top 5 customers, 25%, that's high risk. A single customer at 15% or more, that's a significant valuation impact. And 82% of failed businesses are citing cash flow problems. So then we come to the financing gap. 62% of buyers are expecting seller financing, and only 23% plan to provide it. So that 39% point expectation gap really kind of shows, where the issues are. Now, let's take a look at the market sentiment. 40% say the market favors buyers versus 26% favoring sellers. By the way, this is from the second quarter of 2025. 55% report inflation hasn't eased. I mean, we look at it, things have definitely slowed, but, prices have not really adjusted to anywhere close to pre-pandemic levels. 46% face tariff-related cost increases, and 68% say customers are being more selective. So here's the key takeaway. The agreement isn't the finish line. It's really more like mile marker 20 in a marathon. And really, due diligence is where businesses that are unprepared go to die. In fact, this is such an important part of the process. I actually have built a platform that I use to track due diligence to make sure we not only have all of the documents, but the documents are satisfactory, because there's a difference between having all of the documents and making sure that the documents are saying that, yes, you're ready. Now, I'm not saying you cook the books. I'm saying you obviously need to get everything together, but at the same time, you need to work and make sure that everything is clean and clear and is in best shape possible. So let's take a look now at the family business tragedy. Succession survival rates for businesses. Only 30% of businesses, family-owned businesses, survived to the second generation. 12 to 15% reached a third generation, and 3 to 5% extend to the fourth generation and beyond. Globally, only 13% survived through the second and third generation. Well, what are some reasons for this? Well, one is the death factor. 47.7% of family businesses follow the founder's death. 29.8% involve an unexpected death, and only 16.4% failed after orderly transitions. So here's the planning reality from this. Only 16% have documented and discussed a succession plan. This is family-owned businesses. Only 70% desire to pass on to the next generation, but 30% succeed. So there's that 40% gap, 40 percentage point gap there. And then 47% are expecting to retire within 5 years, but they don't have a successor identified. And, now let's say, okay, we've done some planning. Well, here's the successor readiness crisis aspect of this. Second generation leaders have a 60% failure rate. Second to third generation, 90% failure. 60% of failures involve lack of trust and communication, and only 39% have developed formal development plans for future leaders. So in other words, obviously leadership is important, but here's also the reality is part of the reason why it's so hard is, you might love a certain field and create a business. Your child might be, interested enough in it to make it successful, But their child, they might look at it and go, I've heard about grandpa. I mean, I've seen the business. I don't want to have anything to do with it. And even if everybody in all three and four and so on of those generations are interested in it, the reality is, have you done what you need to train? Because again, remember we talked about some of the reasons why there is no formal planning? They were too busy. If half of the business owners and family owned businesses are too busy, to plan, you think they're going to be thinking of leadership development? So here's the key takeaway from this. Hope is not a succession strategy. Without formal planning and successor development, family transitions are going to fail about 70% of the time. And on this point, I will say one phrase that I heard here rather frequently is things will work out. Things do work out. But the problem is they may not work out the way that you want them to. So now let's take a look at the sector snapshot. And this is where the pain is the worst currently. There's a bit of a manufacturing crisis going on here. According to BizBuySell, in the second quarter of 25, transactions involving manufacturing companies are down 28%. Median prices are down 7%. Cash flow is down about 19%, and revenue is down 26%. Now let's take a look at the restaurant industry. There's been an 8% cash flow decline despite 6% revenue growth. A lot of this could be attributed to inflation, which I know, and having talked with a lot of restaurant people in the food service industry, you have this, you also have liability laws due to liquor. So, even though there has been a steady revenue growth, the fact is there are a lot of other costs that have not only eaten into that revenue growth completely, but they've eaten further into the profit margins. Acquisitions are down 16% in the restaurant margin, and prices are only up 3%. So let's take a look at valuation multiples by sector. Restaurants, that's 2.18 is the multiple. Retail, 2.32. Truck stops, 4.43. Assisted living, 4.35. And car washes, 4.12. So, not all businesses are created equal. Sector dynamics are significantly impacted both salability and valuation multiples. And I didn't even get into the tech sector. And part of the reason why I didn't want to bring up tech or any SaaS companies is, though, especially with AI right now, is the multiples are sky high. And, there's a lot of talk about there being a tech bubble involving AI. I personally believe there is one. I don't know how bad it is. I've heard some people saying that this is going to be really bad. I think there's enough to support that. But at the end of the day, you go with what you know. And just because of the fact that the things are really hot in the tech sector, they could conceivably cool off substantially here in the next few years. It's hard to say. I don't have a crystal ball. I can't read the future. So now let's take a look at something which really should catch our attention, and that is the progress paradox. Awareness without action. Now, from 2013 to 2023, the Exit Planning Institute noted a series of 10-year improvements. Exit strategy as a priority jumped from 6 to 69%. Formal education on this jumped from 35 to 68%. Awareness of exit options from 34% up to 70%, and a formal valuation within 2 years from 18% to 60%. Those are some phenomenal improvements. And dare I say that a lot of this is actually helping long term. We haven't gotten a chance to see it impact a lot of the numbers, but I do believe that a lot of numbers we have looked at throughout this over time in the coming decade will likely begin to change for the better. They're not going to become super good, but I do think we are seeing some progress. But with this 10-year improvement, this is the reason why we haven't seen substantial changes. 78% lack transition teams, 49% have done no planning, 94% have no written personal plan, and 54% of forced sellers ignored the warning signs. So there's a bit of a fundamental disconnect. As well, there's awareness that's greatly improved. It's the execution that needs to change. We made incredible progress on awareness, but knowledge without execution, it's just really expensive entertainment. And you're going to pay for it dearly at the end of the day. So let's take a look at the successful formula. What is it that the 20% who's 20 to 30% who exit successfully do? Well, exit planning, it should begin about 3 to 5 years before the target exit. When you start getting the business optimized and ready, a lot of the services that I offer, and this allows you the time to close valuation gaps, strengthen operational foundations, build management depth, and build out the leadership team, clean up financial documentation, diversify your customer base, and increase predictable cash flows. Now, the 7 operational pillars that I use will help address all of these. Data and analytics will give you demonstrable metrics and KPIs. Budget development controls will give you predictable financial management. Strategic planning will give you a clear growth roadmap. Process, policy, and procedure development will create transferable systems. Operations optimization is going to increase efficiency and margins. Multi-channel marketing is going to give you diversified customer acquisition. And tech analysis improvement is going to give scalable infrastructure that is going to well position you for the sale, but also after that, especially when it comes to earnouts from the sale. So here's a key takeaway. The 20% who succeed don't think about exit planning. They systemically execute against a comprehensive strategy years in advance. So I wanted to just end this deep dive into these numbers with a bit of a call to action, and that's the cost of waiting. Here's the urgency equation. 49% of business owners plan to exit within 5 years. Of course, we've already looked at the 10-year gap, and it could be anywhere from 73 to 88%. The average time to prepare properly is 3 to 5 years, meaning that any delay is going to mean missed opportunity to significantly optimize the value of the sale. Now, there's a huge return on investment of preparation. It could be anywhere from $900,000 to $2.5 million in recovered value. And that's on average. You do the math. I have a monthly retainer of $5,000. That amounts to $60,000 annually. If I'm engaged for 5 years, that's $300,000. If you're paying $300,000 and you're able to recover 2.5 to maybe even, let's say, 10 million in value, that seems like a pretty good investment to me. So you'll also be able to avoid the 10 to 20% valuation discount when private equity knows you need to sell, and they're going to insist on a rather steep discount. You could increase your price potential by 40%, and there's a 3 to 4 times higher satisfaction rate that's on the table. So here are the next steps that I would encourage you. Get a business valuation. If you were to engage me to assist, I would tell you, get a business valuation right as soon as I come on. Conduct your operational readiness assessment. Identify your top 3 value gaps, build a professional transition team, and to develop a comprehensive 3 to 5 year exit plan. Again, with the exception of doing the business valuation, I could help you with areas 2 for 5. on this. And I would love to be able to assist and just give you the guidance and really help you build something that has significant transferable value. So I'm going to leave you with this final statistic. Remember, the 2 to 3% of owners who begin the exit process end up genuinely happy with the results. My goal, if you work with me, is to help you get into that 2 to 3% area. The difference between that 2 to 3% and everyone else is they started planning years earlier, not months. And not only did they start planning, they executed. So, again, I wanted to thank you for taking the time to listen to this webinar. I would love to talk with you if you've listened to these numbers and really have concluded, like I have, just the importance of uh, heeding what they have to say. And, if you've decided that you need help and these numbers tell an ominous story and you want to be successful and in that 2 to 3% as opposed to becoming a cautionary tale, please reach out to me and I would love to be able to talk with you and help you succeed in some way in this capacity. I want to thank you again for your time and hope you all have a wonderful rest of the day.